3 weeks. That's how long U.S. stocks have been falling. Just this week, the S&P 500 fell about 0.6%, the Nasdaq dropped nearly 0.9%, and investors suddenly started asking a terrifying question. Is the global economy about to slow down? And the trigger is not earnings, it's war. Right now, tensions involving the U.S., Israel, and Iran are escalating, and oil traders are watching the Strait of Hormuz, a narrow waterway that carries nearly 20% of the world's oil supply. So oil prices jumped above $103 per barrel. But here's the real mystery. Why does a conflict thousands of miles away make your retirement account drop? Let's follow the money. Imagine you buy $50 of gasoline. About $25 goes to crude oil producers. Around $10 goes to refining companies. Roughly $8 goes to transport and distribution. About $5 goes to taxes and fees. And the gas station? Sometimes it keeps just $2 in profit. Now imagine oil prices rising 20% overnight. That increase spreads across transportation, food prices, airline tickets, and shipping costs. This is called cost-push inflation. Cost-push inflation means rising production costs force companies to raise prices. And once inflation rises, central banks hesitate to cut interest rates. This is the second clue. Investors were expecting the Federal Reserve to cut interest rates later this year, but higher oil prices could keep inflation around 3% or higher, which means interest rates may stay high. Economists call this higher for longer. High rates reduce liquidity, meaning less cheap money flowing into stocks, and that's when markets turn nervous. Now here's the power structure. The global oil market looks competitive, but in reality, a handful of countries and companies dominate supply. Producers like Saudi Arabia, Russia, and major oil firms control a huge portion of exports. Meanwhile, countries like Japan, Korea, and India rely heavily on imported energy. So when oil spikes, their economies feel it first, and the stock market reacts instantly. You might be thinking, haven't we seen this before? Yes. In the 1970s oil crisis, energy shocks triggered global inflation and a long market slump. But compare that to 2022, when energy prices surged, yet markets stabilized faster thanks to diversified energy supply. So what happens next? If the conflict expands and oil keeps rising, inflation could return. But if supply stabilizes, markets may recover quickly. The real question is this: are investors overreacting to geopolitical risk, or are markets quietly warning us about the next inflation wave? Tell me what you think in the comments, and in the next video, we'll investigate something even more surprising: why gold is suddenly moving across borders again. If you enjoy economic mysteries like this, consider subscribing and leaving a like.